Thank you, Arthur. Good morning, dear colleagues. Okay, we proceed with second keynote session survey and question number 1. What is the practical difference between raising equity through the public and private markets? Regulation, cost, transparency and corporate governance, compliant resources, or all the above? After choosing the answer, please scroll down to the question list. And question number 2. What are the greatest drivers of cost of capital? Time to production, permitting, management team, jurisdiction, all of the above. Same thing here. Scroll down the page, please. And after returning back to the question list, question number 3. What is the least dilutive form of capital? Gold loans or the equivalent debt streaming, royalties or equity? Then please scroll down the page. And keynote session question number 4. What is the most desirable and therefore cheapest end product to finance? Dirty concentrate, metal, clean concentrate, precipitate, beneficiated ROM. And the last question, question number 5. What is the biggest challenge in financing with a Chinese SOE? Cultural differences, managerial control, transfer pricing, corporate governance, all of the above. Thank you.
I think actually we have a winner for China. Right. So we're going to be. I'm going to be introducing to you Stephen Rudowski. He is the founder of the Talix Commodities Capital. So the way I suggest to run this session, so Stephen will be introducing speakers one by one, and then we have, I'm sure, time for questions at the end of the session. So if you have some kind of questions, you want to raise your hands. We'll bring the microphone to you so the interpreters could hear you and translate your question, and then ask your question. If you're shy, you don't actually like to use the microphones, please use your mobile phones. Just send a private message to the speakers. They could either answer you at this particular panel or could meet you up at the coffee. So we are hoping to have coffee break at 10:30. Stephen, over to you.
Good morning. So if I do it like this. Okay, first of all, thank you, Arthur, for this opportunity for speaking. I think Arthur's been a tremendous organizer here, and just it's an absolute honor to speak at one of your conferences. Thank you. Just a couple of words about me and what Talix is. So Talix does two things. Talix is a regulated UK company, and we do sell-side M&A. That means that we work with junior mining companies to both put together a deck, an investor deck, and we go out and raise money with our specific investors. Within that model, we often put our own money in, but usually those amounts tend to be 15, 20 and above, so the amount of money that we put in is can be quite insignificant. The other part of our business is we actually drive the deal in the sense that we actually put our own money, and then we effectively use our friends and family, and we actually raise the amount. Primarily we're active in Latin America these days because that's where we see the opportunity, and we're very focused on precious metals and base metals, and specifically concentrates, because that's where we see the value in the market today, and you'll see that as I go on in the presentation. Okay, so my view in terms of the public markets today, and let me just say that a lot of the information which I'm putting forth to you today is anecdotal in the sense that I speak every month to 50 or 60 investors, and I'm speaking to the various trading companies in that community, which I've been a part of for 30 years. So I'm ex-Glencore, and I worked with big trading companies, and a lot of what I do is driven by the physical product, okay? So a lot of the information, a lot of the data that I'm putting forward to you is by investors, but a lot of the information is driven by the physical commodity markets. So in terms of the public markets, by the way, which Talex does not really get involved with, we work with public companies, but we're working really at the project level. So today, the public markets, and the main problem that we're seeing is that there are very few IPOs. And for example, on the AIM market in London, there was only one IPO in the first quarter. And I don't believe there's been any IPOs in the second quarter. So the markets are fairly illiquid. The broker-dealers in that market are not able to raise money. I know that the Wood Mac guy yesterday showed in one of his graphs that there's been an increase in 2018 in the capital markets in Toronto, but I think I would argue in 2019 we're just not seeing that. So the problem that's exacerbated within that model is that there's almost no trading volume. So you have this plethora of mining companies on AIM or TSX or TSXV or ASX, and virtually none of them trade. So there's unbelievable illiquidity, and with illiquidity becomes you don't have any visibility on price. So that price that you're seeing on the market really is almost irrelevant because there's almost no trading volume. With a lot of exceptions, the focus amongst the money markets really is on the larger assets. So in the junior market, where market caps could be $5, $10, $15, $20 million, this is just not attracting any kind of traction on money investors. And a lot of that is, of course, driven by various mathematical equations where they put money. So what we're seeing is really the BHPs and the Rios and the Glencores, they're attracting any kind of money that's coming into resources. This is my personal view. And we're just not seeing the traction at the junior mining level. Any points? I think the other point in terms of the public markets and what we're seeing in the junior market specifically is that the investors are seeing, or their perception is that the management teams are of poor quality. And I think that also is exacerbating the problem of investment into that sector. And also, I think some of our speakers yesterday spoke about battery metals, which is an interesting topic. But I think on the physical side, and when I'm talking with my investors, there's not that kind of traction. We talk about lithium or cobalt, molybdenum, vanadium. It can be a discussion, but it doesn't really elicit any kind of attraction beyond some interest. But the real interest really is on the precious and the base. Moving on to where I see most of the money coming today, and if you look at the capital stack on the public markets and on the credit markets, this is where most of my traction is. When I go out to raise money for a company, this is really where the traction is. So, and specifically within this, if I talk about gold, silver, copper, lead, zinc, nickel, that really encompasses where most of the interest is. In terms of concentrates and metals, again, investors can be very, very picky because obviously there isn't that much money in the sector. Right now I'm talking about the junior sector, smaller deals. So the real money is in the concentrates, and the reason for that is with the trading companies, one can actually lend or do a pre-export finance or can do some kind of streaming or gold loan or however you want to structure it. And even if they, looking at a headline cost of 8 or 10% on the cost of capital, their ability to make money on a concentrate, blending it, and then sending it to refineries, doubles or trebles their profitability. So there's a real drive to focus on concentrates. A lot of the traders think that battery metals are overvalued and overhyped. Again, I don't want to get into that whole discussion, but when you're talking about the physical, for example, on cobalt and cobalt sulfate, there is a view that the technology in making cobalt into a sulfate, one can titrate it to 90% rather than 70%, and that on the supply-demand, we're fine. So a lot of it is just hyping for the markets. That's, again, that's not my personal view. That's the view of my investors and the traders. In terms of the pricing of the credit, it's driven by the jurisdiction, time to production, and permitting. This is a very important point in what we do, is that, of course, these projects are very sensitive to the cost of capital, and because there isn't much coming in, the investors can really drive up the cost and actually make some of these projects either uneconomic, or even worse, they can wipe out the equity component of the deal. And I think if you look at the TSX, and you look at many of the companies which are actually producing, because of the debt structures, you'll see that if you really analyze these companies, the equity really is de facto wiped out, because the credit aspect of it is so overwhelming that the real profitability and the real upside for the investors is really on the debt side, not on the credit side. Sorry, not on the equity side. Solutions for the short term. This is, again, my view, is when I talk to my investors and looking at deals, for example, it could be the most incredible asset, 43101 compliant, bankable feasibility study, have all the checks, but if the management team is judged to be ineffectual, incompetent, then there's no way to raise money. So the big thing I see, the way I can add value to a lot of my clients, is really to firm up the quality of the management team. So also in raising money, this is, again, a lot of our clients, they produce decks, because a lot of them are geos or they're mining engineers, and they produce decks which are really a financial person doesn't want to see. What does a financial person want to see, especially now in this part of the market? They want to see the conversion of the production of metal or concentrate into actual cash, and what are the returns, the financial returns for them. So a lot of the decks could be 3-4 pages with an Excel financial model, which is based on the mine plan, and that will get a very succinct message to the investors. Also, what we see more and more is that investors want to look at streaming, physical streaming, meaning that they don't want to just get some kind of return either on the credit or equity side of a deal. They actually want to obtain the physical metal or concentrate. And therein, I think, is the value that we as Tolex provide. It is really, in terms of you're looking at your capital stack and your cost of capital, the trading companies, whether it's the Glencores or the Trafigures or the Mercurias, or there's a lot of them, and there's the Chinese ones as well. They need to drive their trading book, and the only way they can drive their trading book is to obtain physical product. And the only way they can obtain physical product these days is to get involved in the finance of the mine. And this will be, for mining, I believe, this is the cheapest way to obtain capital today. Longer term solutions, if I was an investor and I am in certain mines, I think it's best to sit this one out if one can. If it's about really, you can just hold on for 2, 3, 4 years until the market recovers. That's probably the best thing to do right now, because the markets are, certainly the public markets are so bad, in my opinion, that it's just that I think there'll be an upward cycle in the coming years. There always is, and just sit it out. In terms of Chinese companies, a lot of my clients thinks that's where one goes to find valuations, which are very optimistic. And I've certainly done deals like that. I recently concluded a deal in Chile where my client was only able to get X in terms of valuation, and he got 3X in China. And that was really because he was considered a tier 1 project. It was only at a PEA level. However, the Chinese saw this as a big opportunity to get a Chilean main copper asset. And for that, they're willing to pay a really massive premium. But in terms of smaller companies, I think going to China is a total waste of time, because the Chinese really are only interested in the much bigger assets, which will move the dial for them effectively. The CE, the Central and Eastern European countries, are an excellent place for capital. I know my investors want to invest in this region, and there have been some great success stories. And so, as I say, as long as one can check the boxes, because more and more in the investment or underwriting criteria, one is looking at issues like corporate governance, transparency, good practice. These issues, once we check those boxes, there really is a significant and material interest in this region. Also, I think, just as another point, is because greenfield and exploration is so out of favor, at least from my investor point of view, that is a particularly good opportunity right now. Again, if one can deploy relatively small amounts of money to get something which is very interesting, it's a very good time of the cycle to actually capture that, because there is a lot of distress out there, especially in the exploration world. Anyway, thank you very much. I'm around for any kind of questions afterwards, and I think we'll try to make a discussion amongst the group here afterwards. I think the main point, just in conclusion, is there is still money out there. I think it's really on the credit side, not on the equity side, and it's in the private markets, not in the public markets. If one goes out there and is incredibly focused and realistic, one can attract finance as long as you can check the boxes of the investment community. Thank you very much. So before I sit down, let me introduce Elena, and she's going to speak about sustainability.
Well, good morning, everyone. And first, actually, I would like to thank Arthur, Irina, and their team for another great event. And some of you might know that MINEX will be celebrating, I think, 15th year anniversary this year in Russia. And it's been a great pleasure to be working with MINEX since 2007. So for 13 years in different countries, in Russia, UK, and now in Balkans. So my topic will be slightly, kind of all about the same. It's all about money, but from slightly different angle. Mine investors want to see, but from sustainability perspective. I'm not sure you can read quotes which are on the slide, but I'll summarize them for you. Within the last, environmental and social issues and matters, they've been kind of mainstream for quite a while, both in mining industry and in other industries, of course. But within the last maybe 4 or 5 years, I think we've seen quite a major developments, particularly in the investment world and in financial world. And the quotes which you see here, they're from very different companies. One is BlackRock, which is one of the largest private equity funds in the world. Another one is Allianz Capital Investors, and HSBC, which is, again, a big commercial bank. And all of them are underlining the importance of sustainability risks. And what's interesting that it's not only impacts from the mine or from the project, it's actually impacts of the environment on the project. And this is kind of a new trend which we have been observing for the last several years. So it's really a twofold process: sustainability risks from the mine and from any activity, and for the mine. And investors now really trying to see kind of what implications, what financial implications this can have. So why they're doing this? And again, it has been, with environmental and social risks and impacts, they've been in presence for many years. So why now? In 2000, one of the triggers then was that in 2017, World Economic Forum issued, I guess, another set of a review of global risks. And climate and environmental risks came on top of all the global risks, both for society and for businesses and just in general. And okay, that's kind of good as such, but what it now means for the investors that they are under increasing scrutiny from public and from policymakers to demonstrate how they, investors, contribute to the circular economy, how they help in mitigate climate change and climate exposures. And yeah, so it's basically just presenting really kind of risks for them and a lot of pressure for them. Yeah, these bubbles, I know you can't read, but just trust me, these bubbles are basically climate-related and environment-associated risks. And what it means, that basically what it means for example, for mining industry and for other industries, that investors, they scale down all these requirements and expectations to the projects which they're investing in, or investees and assets. Again, and you can see here, this is kind of quite, obviously it's a graph, not precise, but it's aimed to show the number of different requirements. And you can see the beginning of 90s, well, in like towards the end of 80s, there's probably one bank, which was World Bank, which was considering environmental standards. And now it's pretty much almost everyone in the financial and investor sector has to comply with some sort of standards, requirements, or principles. Particularly important, and I would like to mention, for example, PRI, which is Principles of Responsible Investment, which have 1,500 signatories. So it's all the biggest asset managers and asset owners and some of the service providers. They subscribe to this set of principles, and they're basically saying that we're going to consider environmental and social implications from the investments. Then another one is, of course, quite famous. It's Equator Principles, again, signed up by over 80 banks, commercial banks from around the world. So pretty much whenever you go, that would be there will be banks which signed up to those principles, and they have to apply them if they're providing loan of over 10 million, which is obviously not a lot. And then the same would be the principles of responsible insurance. There are obviously green bonds principles. There are different documents issued by stock exchanges, so for example, London Stock Exchange, Toronto Stock Exchange. So there is a growing number of these requirements. And I kind of would like to underline that it's kind of whether they believe in the value of those standards or not, but these standards are there and the requirements are there. And obviously the requirement to comply with them is also there. However, obviously the landscape of sustainability risks is quite broad. But there are probably not that many of them which would be real deal breakers. And I would like to highlight three, which in our experience as sustainability consulting company, we've seen they can be a deal breaker and they can be actually a showstopper. The first one is climate change. And I'm not a climate expert, and if I could, I probably would have tried to avoid this topic, but it's impossible. It's virtually impossible to avoid climate risks and climate change related topics if we speak about sustainability expectations of international investors. So because this, obviously it's kind of everywhere now, and I think it's probably every reputable financial organization of a decent size issued some sort of statement on climate risks and climate disclosures and so on and so forth in every industry. And they apply it for every industry, obviously including mining. The biggest push for that, again, why they're doing it, the biggest push for that came from what's called TCFD. So back in 2015, G20 asked a Financial Stability Board to actually look at climate risks and the implications for the investments and for financing. And what they did, it took them about 2 years, and Iran was involved in that process, and we were working with task force on climate-related financial disclosure. And exactly 2 years ago, in summer 2017, they issued their recommendations. And starting from the next year, these recommendations are going to be obligatory for all PRI signatories. So what it means, again, probably very difficult to read here, but it means that financial institutions will be obliged to report about governance systems which they have in place, they financial institutions and financial organizations, to manage climate risks, and also how they assess climate risks in their portfolio, whether they assess it or not, and kind of, so there's like really big system in place which financial institutions and financial organizations are expected to have now. And of course, they're scaling this down to the companies, to the assets, and I have to say this is probably one of the areas which is probably growing, not only for us, but I think probably for most of the consulting companies which work in that space, because there are a lot of concerns, but the good news is that there are a lot of tools. There are a lot of tools how it's possible to assess climate-associated risks, for example, in the during acquisitions. So some of the work which we do is obviously we work quite a lot with different banks, with private equity funds, assessing risks and their portfolios. And here, a lot of them are making decisions, they're kind of trying to make high-level decisions with regard to where they want to invest. And of course, it can potentially affect mining industry as a whole, because some of them are they're trying to balance out kind of their portfolios to see what kind of exposure they can afford and not to be like too severely scrutinized. So that's obviously one type of activity. And another one is on the next level when we work with mining companies in particular, both actually with large and with smaller ones, and helping them to assess their exposure to climate risks. And as I mentioned before, it's not only impact how they impact in climate, obviously it's greenhouse gas emissions and so on and so forth, but it's also climate resilience, how climate is impacting those assets. So we're helping them to assess kind of these risks, and then obviously then they also making decisions, okay, can they acquire more assets, can they invest in more assets, which might increase their climate-related exposure. So as I said before, this is developing area, and even if I wanted to avoid this topic, it just wouldn't be possible. So this is something which we probably will see more. At least now, even when we work with, of course, like climate-associated risks, they were always there, at least for us, for sustainability consultants. But now there is much, much more attention to this aspect on all the levels. Moving away from climate, another aspect which kind of might sound more common sense for the industry is safety. And of course, yeah, that's kind of, there's no brainer that mining, but it's kind of highly hazardous activity, and but it has to be safe. Again, investor perspective with regard to safety is changing. In my 15-year career with ERM, I've seen a number of examples. One of them was in Russia. It was a project finance deal when a company received financing from a consortium of banks, a development bank and several commercial banks, and the company started construction and they were receiving financing in tranches. But as soon as first fatality happened, and it was a fatality of a contractor of fourth level, so it's subcontractor, they stopped financing. They basically said, like, until you put a system in place, and that's kind of what I experienced because we were monitoring that project from environmental perspective. So basically the company effectively was forced to look at real root causes, what's happening, what system they have in place to manage their subcontractors. It's a project in Russia. And obviously, the company had to like really activate this type of activity very quickly and do all the audits and bring additional people in place and do additional trainings. And we have been monitoring them for 7 years since then, and they didn't have any fatalities. But the point is, and obviously, yes, the financing was restarted. We have another project when we were brought in, effectively called in by the lenders when they realized that the EPC contractor at the construction site was just wasn't able to meet their requirements. And again, I think there were 3 or 4 fatalities within a very short period of time, within like 3-4 months, which is a lot. And obviously, financial institutions do care in that sense because for them it's a really big reputational exposure. So they don't want to be associated with fatalities or severe injuries. And here again, there are a couple of quotes which are very recent, which are obviously quite specific and relate to dam, obviously tailing dam safety. But again, remarkable that this year there was a call for action which was issued by a number of funds, starting from Church of England fund, and they were joined by a number of European funds. Again, calling for higher safety standards and actually more transparency with regard to safety, in particular in mining. But again, the good news is that there is, and I'm sure obviously everyone who's involved in mining, there is a lot of attention to safety, but we quite often hear that there is one thing to blame, and this is culture. And obviously I hear it in my country, so it's a cultural thing, we do it kind of that way. But it's actually possible to change. And again, I've been involved in projects where for example, I was doing engagement with contractors, and 12 years ago for one of the companies, and all contractors were like screaming and crying and saying that the safety requirements of that main company, they're just like insane. They're killing our small little companies, they're killing our industry, we can't work with them. 12 years after, no, because I've been doing they're doing like a risk assessment through stakeholder engagement. There was no single contractor who raised that point. And I had to ask the question because I remember that through the years there was always a complaint at how rigorous the requirements are. And there was literally no single question. Moreover, the contractors were saying, no, we actually use these requirements when we work with other companies in the region. So it is possible to change. Obviously, it is painful. And this slide and the next slide, it's basically the change starts from the top. And obviously, it can be quite uncomfortable process. It requires some courageous conversations, really not accepting status quo, self-awareness, new insights, and then and we see it kind of more and more, even within the companies which have very mature systems with regard to documents and management system. But the one thing which kind of usually requires more attention is a safety culture. And I guess the last one, and I was told I have 1 minute, so that's actually my favorite topic, because that's what I do. It's stakeholder engagement and social conflict management. And again, in my career, I've seen banks literally walking away from projects where there was a potential for social conflict. And under stakeholder engagement, maybe there is just one important point which I would like to make. We consider stakeholder engagement as really broad. So what it means is not just community, and community is extremely important, but it's also to understand who other players are in the region, because I have a project where the company built a brand new facility, brand new, like new technology, and they couldn't launch the operation for 2 years for one particular reason, because people were protesting, and people were protesting because they were charged by one of their local competitors. And I'm sure that, and I've had some discussions yesterday during the break, and for us it also means stakeholder management. It's also knowing who the stakeholders are, who the competitors are, and we do work with a number of companies when we help them to identify these type of issues in advance, so then they can make an informed decision how long it will really take them. I don't know, do they need to hire a PR team, what they need to do to, you know, like maybe they need to start negotiating with some of those potential competitors or slash partners. So it's kind of stakeholder management in a really, really broad sense. And maybe a final slide on that. Again, all financial institutions, neither of them want, first of all, they don't want to be associated with social conflict. And second, it's literally last one.
You have to finish, yes.
Yes.
Okay.
And the second point is obviously there are some studies, particularly in mining industry, which basically demonstrate the cost of social conflict. And it is quite material, and I'm happy to talk about it during the break. But probably the last point is just 3 words. So investors want to see climate resilient, safe, and socially responsible mine. Thank you.
Thank you, Elena. I think I slightly mixed up the order. So Rama, I apologize. So let me introduce Rama. And Rama is going to speak on financing exploration and mining projects in Europe, challenges and innovative solutions.
Thank you very much for MINEX and also having this opportunity to talk in this panel, because a lot of the points that I wanted to mention I've already mentioned, and I can only confirm them. So I'll try to actually share some ideas with you. We, MMG Capital is also a merchant banking firm. We invest in companies that we then help raise capital and provide corporate finance services through joint ventures, mergers and acquisitions, and raising equity and debt. We have been quite active in precious metals, base metals, battery metals, and raw materials for steel. Some of the recent deals that we have done over the past year has been in Finland, Americas like Brazil and United States. But we have been raising capital in basically Americas, Europe, a bit in Africa, and Central Asia. Just very briefly, I wanted to share some ideas. We see in the market that this higher price volatility and the geopolitical uncertainties have created interesting challenges for the mining sector, and it has made it difficult to basically achieve asset valuations and also think about long-term investments in mining. So there is a lot of cautiousness and risk aversion. And in order to come back to that previous years, like up to 2012, when we saw a lot of liquidity in the markets, we have to see retail market and generalist funds come back and invest in the mining sector. For example, in Canada, a lot of the retail investors who used to invest in mining have now dumped their mining stocks and have gone to cannabis and cryptocurrencies. So hopefully those guys will come back, and that will help the liquidity in the market. So it's important to see what are the major themes and drivers that will move the market towards, again, investors coming into mining sector. This battery metals has been talked about a lot, and supply shortages, potential supply shortages in the medium term are a couple of important drivers that keep investors interested. But there's a lot of headwind in terms of demand growth, trade wars, and whether the electric vehicles are really going to grow as expected, and that's putting pressure on demand. There are 8 sources of funding that I would like to talk about, which is retail funds, private equity funds, debt funds, trading houses, vendor financing, streaming royalties, and also, very importantly, strategic investors, other mining companies that would invest in other mining companies. So long term, and this has been covered by other speakers, so I'm not going to go into it in detail, but there is this demand for raw materials, both from electric vehicles and new technologies, and also build up on infrastructure, is going to be key in terms of drivers. We have heard a lot of political discussions in infrastructure, especially in Russia, China, India, and United States. Whether they will happen in the near future or not, it remains to be seen. But we're talking about trillions of dollars being spent on infrastructure in these 4 major markets, in addition to other countries as well, like in Africa. So despite there's been some recovery in mining since 2016, 15, 16, which was very difficult, but we still see a lot of cash scarcity in the market also because of this volatility in commodity prices and focus of the mining companies, major mining companies on operational performance rather than production increase. So they're less keen to expand through acquisitions, more keen on focusing on operational margins and returning cash to shareholders. So that makes it more difficult. There's also, again, this risk aversion and focusing on doing a lot more due diligence from investors that come to looking at mining opportunities. They do a lot more due diligence. They are very focused on margins and profitability. Country risk is quite important. I'll speak to it a bit more later, but in a given jurisdiction, whether you have political stability, corruption, and what's the status of infrastructure and labor productivity and so on are key points. So investors are very, very careful on how they pick countries that they would invest in. And then what's the investor's share of the returns compared to the money that goes to royalty, to taxes, to stake of governments in projects. There are a lot of risks that these mining companies have to manage, like commodity price risk, management risk, operational risk, market risk, and a number of, again, these country risks that really is worth having a whole presentation on, because the worst thing that can happen is when you're operating in a jurisdiction that's then perceived by the investor community as being too risky for investment. Then it will be very difficult to attract investment. And we can go through that during the Q&A potentially. Just when you look at globally where the money flows to and where the exploration projects are, 36% of the money goes towards in North America and Australia, and only 5% is going to Europe, which is surprising. I mean, it should be a lot more given the attractive opportunities in the Nordic countries, in Eastern Europe and the Balkans. There should be a lot more investments and exploration in this region. Now, the reason why is it that we don't see as much investment in Europe, we should look at some key points. On the economics of it, whether the projects are really generating the IRR, return on investment, of 20-30% and more, because in Latin America and other places, we have seen returns of over 50%. So economics is important because the investors compare jurisdictions to each other, and it's important to be in the lower quartile cash cost in case of a market downturn, that you will be able to, or your project will be able to survive. And the resources, whether there is potential for expansion beyond your project that you have that's generating cash, whether that can be expanded to generate a lot more cash and also become a bigger project that will be interested for majors. Again, the share of the returns to investors. The management is important, that they have a track record in that particular geology and that particular jurisdiction. So if it's epithermal deposit, they have done actually epithermal projects in Eastern Europe before, and that the board has a good diversity. They're not all geologists, but there's a good mix of people that can raise capital, that are technical geologists, but also cover sustainability issues, community issues, and basically address all the stakeholders. Infrastructure is very important, obviously, and that's a positive in most of the Europe. You have good infrastructure in terms of road, rail, to ports, and availability of water and electricity. So that's usually a plus in most parts of Europe. And then the communities, the local communities need to be really supportive. So, for example, in Germany, I would say 85% of Germany is against mining, except like you have Saxony, where it's very much pro-mining. And generating projects there would meet a lot of community support. Health and safety was talked about. It's a key important point as well. So beyond having a good assets and good deposits, there are a number of points that we should bear in mind that makes fundraising easier or more difficult. So management competence and having a vested interest in the project, so they have actually are investors or not just employees, is an important issue. Whether the capex is much more than 10 times the market cap makes the project more or less unrealistic in terms of raising capital. The deal size is also important, because if it's too small, it's difficult to get investors. If it's too large, it's also difficult to get investors. So we find that there is a sweet spot of $50 to $500 million where most of the projects get funded. Time to production is really important. It's much more difficult to raise capital for mining projects that are over 4 years from production, much easier when it's less than 2 years. Also, when the project is very complex and can have a lot of potential problems, like if it's deep underground or has very difficult processing of the metal in front of them, that makes it difficult to raise funds. Also, cash is really important. A lot of companies that we see, they wait till the last minute to raise capital, and that's very dangerous, because when you have less than 1 year of cash to operate, then it becomes very difficult. Then people just wait till you're out of money, and then they try to buy your shares at very low prices. So there are a number of, there are about 8 investor categories, and their main issues are always, when they're investing in shares, is liquidity, potential dilution in the future after they have invested, and whether when they give the money to the company, what part of the solution are they? I mean, do they have, and they want to see visibility to full funding towards construction and reaching operations. And then they, of course, assess execution risk of the management and the project. So I put up this slide because it's really important, to know what phase of development a mining company is in. And then there are different investor groups that are perfect for that phase of development. I often see junior mining companies that have greenfield projects and try to raise money from big institutions. I mean, it's not going to happen. So you have to know your audience quite well. And at each phase of development, we have been quite successful in raising money if we match the phase of development with the fund providers. So, and it's important that when you're in a particular phase that you are able to fund yourself with that investor group until the next phase. Otherwise, the mismatch will happen and makes it much more difficult. So initially, the investors are mainly core investors from friends and family and friendly finance providers. And then you move towards getting more retail investors, family offices, and then institutions, private equity funds become a bigger portion of the investors. This is something we can discuss in more detail later. And then the other thing is that depending on your metal, different categories of investors become more interested. So we have been successful, for example, raising money for our clients in base metals, especially lead, zinc, and copper from select group of off-takers that provide financing. And then from precious metals, a lot of mining-focused funds who have the mandate to invest in precious metal mining companies. So there is a range, and we can go through this later as well. I want to say a couple of words about sustainability, but I think it was well covered. It is becoming a very important part of raising capital, and largely it's because it's driven by institutions. So the LPs, the limited partners that invest in private equity funds and other funds, they are also hugely driving this. So the pension funds and sovereign funds and so on, they want this multi-stakeholder approach and sustainability and paying attention to communities and so on. And so that trickles down to institutional investors that then invest in mining. So maximizing NPV must be also in terms of addressing shareholder interest. And there are a number of these points I want to mention. And lastly, I wanted to just say that that it is a difficult market. And I was hoping actually in this conference to have a conversation about how to put pressure on the European Union to provide funding for the mining sector, because I do think that they need to invest in the resources in Europe in order to support their industry downstream. Thank you very much.
Thank you, Rama. So next up is Axel Kalinowski, who's the head of Central and Southern Europe for the London Stock Exchange.
All right. First of all, warm welcome on behalf of the London Stock Exchange. It's a pleasure to be here in this part of the world. Thank you to Arthur and the team for organizing a great conference. For us, mining is obviously very close at the heart of the London Stock Exchange, giving its position and importance across the universe of sectors and companies that we work with. But just to mention, our oldest international company listed on the London Stock Exchange is Antofagasta, a Chilean copper producer, which has been listed on the London Stock Exchange for over 130 years. So that's how long we've been working with mining companies. So that's why I think events like this one are particularly important. Over the next few minutes, I just wanted to use the opportunity to give you a brief update what's happening from a capital markets perspective. Obviously, we all know that the mining sector is a very cyclical sector, and investors come and go depending on what's in favor and what's hot, and maybe interest cools down when things turn down. But generally speaking, public markets play an important role in the puzzle, as an important piece of the puzzle. And so we as a London Stock Exchange very much think long-term and like to work at an early stage with companies, mining companies across the world, to help them explore the concept of capital markets and what ways capital markets can be helpful to them. So with that being said, I'll just give you a quick overview in terms of what's been happening from a capital markets perspective more generally. Obviously, the UK is in the news nowadays on a daily basis, so there's often potential misunderstanding what is actually happening for real. Just to give you an idea, some key highlights from last year, 2018. You would normally think that since this famous referendum took place in the UK, things have come to the halt. That's certainly what the news and media likes to portray, but couldn't be further from the truth. So since the referendum, we actually had some of our best years in terms of investor activity, in terms of deal activity. So that's somewhat counterintuitive. So here's some numbers. Last year, for instance, we had 79 IPOs. I think what's particularly interesting is that IPO and deal activity has been particularly concentrated on foreign projects, foreign companies. So if you are 100% UK domestic business, at the moment it's a challenge, but if you're a business which is sort of operating abroad, potentially generating revenues, etc. abroad, then investors like you, because you have obviously better visibility with those. So because of that, we had 53 international companies come to list on the London Stock Exchange. In terms of landscape, on the European landscape, you can see that London plays a very important role. So also beginning of Q1, so these are Q1 2019 numbers, just the first 3 months in 2019, over $20 billion were raised in London via IPOs as well as secondary deals, which we call follow-on issues, which is close to 6 times the amount of money raised to the number 2 sort of marketplace in Europe. So you can see there's a huge concentration activity in terms of what's happening on capital markets, and that is in London. You can also see that this is sort of a chart around in money available for investments. So it's actually gone up. There's over $300 billion that is mandated for investment in UK companies, UK sort of London listed companies only. That's apart from the pool of investment that is available for investment across different sectors and different sort of geographies. And that money has actually, that pool of capital has actually gone up since the referendum. So that's somewhat counterintuitive again to the narrative that you might be sort of following in the news. So actually there's a net inflow into assets managed in London. You can see that actually quite a good number of foreign companies have actually decided to increase the visibility, increase investor access by adding a sort of a London listing. So these are all companies that had a primary listing somewhere else around the world, sort of decided to add a secondary listing just to maximize investor access. So now I would draw, there's a huge list of companies, more recently a company like Coca-Cola European Partners, which is a big Coca-Cola sort of bottling company. But more importantly, there are also some mining and sort of natural resource businesses which have done the same thing. So we had, for instance, Polios Gold, which is sort of a Russian gold mining company listed on the Moscow exchange. They sort of listed now on the London Stock Exchange as well. We had, of course, the IPO of Kazatomprom, sort of the big uranium producing in Kazakhstan, which was a very successful IPO end of last year. I'll touch on that a little bit later. We had companies like Cosmos Energy, which is sort of an oil and gas business. We had Grant Tierra Energy, which is a Canadian company, which sort of decided they wanted to maximize and improve sort of investor access and added alongside their Toronto listing, a London listing. So there's been a fair amount of activity actually, which is not tremendously well covered, I understand, in the media, but things are happening. Yeah, I just wanted to give you an overview in terms of what the mining sector means to us at the London Stock Exchange and how well represented it is. You can see that we currently have over 160 companies, 164 companies listed on the London Stock Exchange across all kinds of different sort of mining verticals. So you can see that it's an important, very important and well represented sector on the exchange. On the right, you can see sort of that pie chart, that's sort of the investor universe, sort of where investors investing from. So you can see the UK investors 40%, and of course North American investors 34%. So those two groups make the bulk of the investment in mining companies. So those are the most important investor groups. Here you can see sort of the overview of the biggest sort of mining marketplaces across the world. You can see that 3 out of the top 5 largest mining companies are listed in London. You can see that London, in terms of market value that is represented, is sort of the leading venue globally for mining companies. So 23% of global market capitalization of mining companies is represented in London, so almost a quarter. Number 2 is ASX, so the Australian Stock Exchange. And then much further down, you can see Toronto and some of the other marketplaces. Yeah, here you can see in terms of European funding activity over the last 10 years. So close to $20 billion have been raised by mining companies in London, again, a multiple to European exchanges. Just wanted to touch on, because we heard before that sort of there's not a lot of money around for mining companies. It depends what mining company you are. So that this is not a sort of a global statement you can make. It really very much depends what sector you're in, what is your business activity, etc. There's actually potentially quite a lot of money available. It just depends whether you fit the profile that investors are looking for at a particular point in time. And that changes constantly, so no one can give you a firm view. What's true today might not be true tomorrow. So that's something that needs to be tested, and that's what we're here for, is the London Stock Exchange, to help you sort of explore that. But to give you an idea, sort of end of last year, we had Kazatomprom, which I mentioned earlier on, come to London for the first time. Biggest sort of IPO out of Kazakhstan since 2006. Privatization, because it's a big sort of company in Kazakhstan, and they managed to raise $451 million during the IPO from a huge sort of range of institutional investors. So the share price has also done well since then. It's up roughly 20% since IPO. So the money is there, but obviously that's a large cap and very mature kind of project, but money is there to be invested. Interestingly, also we had the listing, for instance, of Tharisa, which was a Toronto listed, or is a Toronto listed company, which decided to add a sort of a London listing to boost liquidity. So you can see there's a little bar chart on the left. You can see sort of liquidity before the secondary listing in London, and then sort of post listing in London. You can see sort of the liquidity has jumped quite significantly. Sorry, it's not Toronto, it's Johannesburg listed. And it's sort of half-half now in terms of trading liquidity between Johannesburg and London. So this is sort of, again, just to showcase that there can be an additive effect of adding sort of a listing. And then sort of the last thing that's quite interesting, I think, in terms of future developments to point out is that we as the London Stock Exchange are working very hard to sort of bring markets together. And we sort of realize that over the last few years, we've seen an increasing trend of Middle Eastern money, but also Asian money playing sort of an increasing importance. So what we've done as a result is we have worked very closely with the Chinese government to establish a direct link between mainland China, so Shanghai, and London. And so it's the first of its kind. Hong Kong is sort of a little bit outside of the mainland China narrative. So it's the first time that we have a true linkage between mainland China and the London market, whereby basically it's possible for London Stock Exchange listed companies to attract Chinese investors, and Chinese investors vice versa being able to attract sort of the global investor pool that London represents. So that's forging a close link, and I'm pleased to say that a few days ago, so just a few days, this was a project that we worked on for many, many years. You can imagine it's very political, because for China it's not very easy to open up and establish sort of a direct link. So with big political support from the Chinese up to the very top, we managed to establish that link, and that's now live and operational. So literally a week ago we had our first Chinese company list in London. It's called Hutai Securities. It's a financial services, financial investor kind of investment conglomerate. Very big. They raised $1.5 billion in London, and basically are trading now on both markets. Chinese A shares traded in Shanghai Stock Exchange, as well as trading in London on the London Stock Exchange. And this is obviously, it's just the first company, but we see sort of the vision of the project is that we will see more Chinese companies sort of accessing global markets, but equally more European companies, UK listed companies, tapping into the opportunity of getting access to sort of Chinese investment pools. So I think this is relevant for you over time, not from tomorrow onwards, but over time. The idea is obviously to expand the scope. At the moment it's limited to FTSE 100 listed companies, but over time this will potentially increase and sort of be available to a much larger pool of companies that are listed on the London Stock Exchange. So that's something that we are working towards too. All right, that's pretty much it. I'm available throughout the day. So very much look forward to sort of shaking hands and having conversations with you, and look forward to sort of finding out more about the exciting project. So thank you very much.
Thank you, Axel. So next up is Bernard Mayer, and he's speaking about foreign investment in the mining sector. What lessons for the future can be gleaned from the past?
Thank you. Thank you, Stephen, and thank you also, Arthur, for having me here and for the impeccable organization. I have to confess I'm going to be a bit on a downer compared to everyone else. So everyone else on this panel has been talking about raising funds and sort of getting the investment off the ground. But my background is in disputes. So I generally get called when things haven't gone so well and when the political risk has materialized. I don't have a fancy slide about my practice, but I encourage you to study the many promotional materials prepared by my marketing team on our website. We're a huge law firm, undoubtedly one of the best in the world, but I would say that our slogan is one of the world's most integrated law firms. I don't know what that means, but it's a very good law firm. My background is public international law, so I do advisory work, and I help investors structure their investments appropriately before going into volatile and often high-risk jurisdictions. Now, my introduction, I saw an article a few days ago saying strategic minerals - the new global battleground. And I thought that was quite interesting because, as we heard yesterday from our colleague of Eurolithium, rare earths, cobalt, strategic minerals are key ingredients to the EV revolution and the modern digital economy. As you all know, the natural resources necessary for the digital economy and the mobility revolution are interspersed throughout the world, often in high-risk jurisdictions, and it's very expensive to extract these minerals. Investors, as Rama pointed out, often depend on their ability to recoup their investments over significant amounts of time, and as our colleague from Belgium pointed out yesterday, it can be very challenging to maneuver the complicated frameworks of national mining legislation and regulation. And so now my presentation will basically be about once you've raised the funds successfully, once you've given Stephen a call and managed to raise the funding, how do you protect your investment? And as Rama said, political risk is worthy of a presentation on its own. So I'm not going to go too much into that, but also what lessons can we learn from past cases? So how can you protect your investments? The first one and most traditional one is diplomatic protection. So basically, you've gone into a volatile jurisdiction, you've encountered a problem. What do you do? The first thing, I think you would pick up your phone to Tim of the embassy here in Sofia, and he's raising his hand, and you would say, look, I'm in trouble. What can we do? And the amazing team from the Department for International Trade or your embassy, if you're Canadian or Austrian, will try to help you, and will set up some meetings and talk to the right people within the ministries, and hopefully the problem will go away. That's one option. The other option is political risk insurance, and it's interesting because Rama's question for discussion in this group was how can we get the EU to help financing in the mining sector. And in April 2019, MIGA and the EBRD actually signed a MOU for greater cooperation for the use of the institution's respective financial products. And as far as I'm aware, that has been used for a 250 million infrastructure project in Turkey. But why don't we try to use that in the mining sector as well? The downside is political risk insurance is generally hugely expensive, and so it may not be suitable for smaller projects. The thing I'm most excited about, because it's my day-to-day practice, is investment treaties. And these treaties, who have been in the news quite a lot lately, allow investors to bring actions directly against host states if things go awry. So if there is a long-term promise for a license or assurances made in inward investment, and then the host state government reneges on those promises or cancels the licenses arbitrarily, those treaties allow investors, if there's appropriate structuring in place, to put pressure on the government to let's say, behave properly. Now, there are a number of treaties. I've just listed the number of treaties in the sort of region and countries that are relevant in this conference. But there's also the Energy Charter Treaty, which is much bigger and is a multilateral treaty. Unfortunately, I recently found out that the Energy Charter Treaty doesn't cover copper, for example, because it's limited to energy materials, but it does cover uranium and coal. So before structuring your investments, do check what is covered by these treaties. Now, what do they do? Some of my nifty colleagues have devised some fancy language, like fair and equitable treatment, full protection and security, due process, protection from expropriation, and these terms are interpreted regularly by tribunals. These treaties are subject to public international law, which is quite a sort of a term that's widely interpreted by lawyers, and often government's behavior can be brought within these terms. Now, rather than giving you a lot of sort of hypothetical background on the system, which I'm sure many of you are aware of, I thought I'd just mention one of the cases that I was involved in very recently, involving Kenya. A Canadian UK junior miner went into Kenya and invested in Mrima Hill, which is said to be one of the world's largest niobium and rare earths deposits, worth many billions of US dollars. And between 2008 and 2013, Cortec carried out exploration, and according to their own account, spent around $40 million in doing so. They lobbied the government very hard, so that in May 2013, they were given a mining license, which they were very happy about. It was a 21-year license, so they thought, great, our investment's going to pay off. Unfortunately, the government changed 3 days after, and the mining minister then went on to Twitter and revoked the licenses. And so it's very small here, but he says, Cabinet Secretary Balala revokes all mining licenses issued in that period. Now, the investors who were on Twitter were quite unhappy about that development and decided to sue Kenya on the basis of the UK and Canada-Kenya bilateral investment treaties. They claimed over $1 billion in compensation. Now, given their investment of 40 million, that would have been a fantastic return on investment, and I'm sure that Rama and Stevens investors would be very happy with that ROI. But unfortunately, the Kenyan government, which I represented at the time, made some very good arguments. and said that these licenses had actually been void from the very beginning because Cortec had ignored the special protected status of Mlima Hill as a forest reserve, nature reserve, and national monument. So the Kenyan government put forward a very robust defense, and unfortunately for Cortec and its investors, the tribunal found in favor of the government. And you'll see here I think probably the key part of the judgment was that the tribunal found that the license was nothing but a scrap of paper issued by an irresponsible bureaucrat contrary to specific legislative requirements. So that was quite unfortunate. There was obviously, I mean, the judgment is available online. You just put Cortec and Kenya into Google and it gives you the PDF. I mean, it makes for a fascinating read, and as I said, the government's arguments were very, very strong, but it can go the other way as well. Now, I've just put a sort of a key takeaways slide together, which I think is very clear. Adherence to local law is very important. So our Belgian friend yesterday, I encourage you all to go back and reread his slides and sort of get familiar with the millions and millions of mining laws available in the EU and in the country that you're going into. Tribunals look at the whole picture, so if things do go wrong, these international dispute resolution bodies are not so much legal judges as finders of fact. So they will look at investors' conduct when they go into jurisdictions. They will look here. You will see contribution to host state development that featured quite prominently in the decision. So they had looked at what Cortec had done in Mlima Hill. Apparently they had built a medical clinic, which there was no evidence of whatsoever. But I think if you do go in and you do contribute to the local community, that's very helpful. And finally, corruption is very difficult to establish in practice. So the government ran a corruption defense and said, we don't have any evidence that this license was procured by corruption, but there were a number of red flags that suggest that things were not quite as they seemed. The tribunal dismissed that and they said, look, corruption is a very serious allegation, and unless you have evidence of this either in writing or by witness, we're going to dismiss this immediately. And yeah, so that was the Cortec and Kenya case, and so I think political risk is as Rama said, probably one of the most important things that investors will look at. But I do encourage you to look at these investment treaties when you go into volatile jurisdictions, and consider in the long term, even though things may look good at the beginning, what would happen if things go wrong. And so that's my presentation.
Thank you very much. Okay, last up is Tanya Ilieva, who is the senior geologist at Micon International, speaking on mineral resource reporting, differences between CIM, JORC, and others.
Hi, my name is Tanya Ilieva, and just a second. I work for a small consulting company. The company was founded in 1988, so we celebrated 30 years. This is an independent, employee-owned company. It means that we all are shareholders, and we all are trying to do our best to keep the company going and to keep our clients happy. So we are geologists, mining engineers, processing engineers, and environmental engineers. Like any other consulting company, part of our business is mineral resources, mineral reserves, mine planning, due diligence, independent reports, technical services. Practically, if a client has a question, we have to be able to answer and meet their needs. In many cases, we have external consultants for the stuff that we don't understand or we don't know. I'm based in Toronto, and Toronto is a city that has people from at least 120 different countries. So we can accommodate the needs in any part of the world. I graduated at the University of Mining and Geology, and I'm the practicing member of the Association of Professional Geologists. My professional experience is more than 25 years. I'm the QP for many projects, mainly base metals, precious metals, some of the industrial minerals, mainly hard rock lithium. And it doesn't matter if you graduate, let's say, uranium exploration in the University of Mining and Geology, if you don't practice more than 5 years, or if you don't have at least 5 years recent experience, you are not a QP anymore. So I'm really happy that I work for a consulting company. I can work with different commodities and keep my qualifications. These are the MICON projects all over the world. So as a geologist, I'm the lucky one that goes to all these exotic destinations. But, you know, I think that this is an adventure, and I don't regret it. Our head office is in Toronto. We have offices in Vancouver, in Norwich, in Cornwall, and we have representatives in Paris and in Moscow. So this is the mining project in the eyes of the investors. You acquire an exploration license or just take a claim on the internet. In Canada, this is possible. Drill a few holes and sell the project to a bigger mining company and make a lot of money. Or just start mining and get rich overnight. And this is the real life cycle. We go through a long process. It can take 10 years. In some cases, it can take 20 years until your project gets into production, if it ever gets into production. During all these 20 years, the mining regulations change, the codes change, the companies get listed and delisted, so we have to file a lot of different reports, and we have to follow the current reporting standards. So we have thousands of people that worked really hard to create wealth, but there's always one or two of us that think that they're smarter than us. And there were 2 scandals that really were the reason for creating the different reporting code. The first one was in 1969 in Australia, and it was the nickel boom and bust. And this led to the creation of the JORC Committee and the JORC Code. The second big scandal, at least the one that we study in the textbooks in Canada, is the BRIEX scandal. I assume that you guys, you've seen the movie Gold. The movie is a Hollywood production, and just the names are different. The company was based in Calgary, raised a lot of money. Everybody who invested in the company was thinking that they are rich. When the fraud was discovered, people lost their investments. Some people, they sold their houses to buy shares. So to avoid all this disappointment and all this pain for the whole mining community, there are multiple codes. So the so-called CRISCO started in 1994. In 1997, there was so-called Denver Accord that created 2 major categories. Mineral resources with measure, indicated and inferred, and mineral reserves with proven and probable. So the latest CRISCO update is from 2012. And these are the CRISCO members and their reporting codes. So very often clients are asking, okay, my project is, let's say, in Kenya, or my project is in Ontario. Can I use the JORC code? And as a consultant, I can't tell the client what to do, but my advice is, if you are listed in Toronto, or if you are going to raise money in New York, you have to comply with the strictest regulation. So when the code is updated recently, usually it has more requirements. In our case, if you are listed in Toronto, follow the NI 43-101 standards and definitions. If you are listed in Bulgaria, where are you raising money? If you are going to raise money in Toronto, you can stick to NI 43-101. If you are going to raise money in London, probably you should follow PERC. If you are listed, if you are going to raise money in New York, you have to go and you have to follow one of the strictest guide, and this is SME guide for reporting exploration results, mineral resources and mineral reserves. Of course, the client can choose. So who is using our reports is the exploration companies, and who is using these codes? These are the exploration and mining companies, the financial and investment community, and the consultants that are writing the reports. We know the fundamental principles, their transparency, materiality, and competence. PERC has introduced something that is called impartiality, practically independence. You have to disclose if you are independent from the project owner or if you are not independent. If you have shares, if you have worked on the project, we do all this in our certificates. This is the general relationship. I said that it was introduced in 1997. This is the relationship between exploration results, mineral resources, and mineral reserves. What are the similarities between these 10 codes? So they all have the minimum standards. And these minimum standards, they apply. It doesn't matter if you are going to release exploration results in a news release or promotional presentation of the company or a full report. They apply for, so we have in the guidelines, we have certain criteria. PERC, JORC, and SMI, they have an appendix called Table 1. I'm sure you've seen the Table 1. You have to address every single criteria in this Table 1. NI 43-101, we prefer a template and we prefer a written report. So immediately there is a question, when do I use the table, when do I use the full report? If you are announcing exploration results in a news release, your code will require to attach a table 1 to your news release. If you have a report that discloses the mineral resource, mineral reserve, then you have to attach the table 1 at the back as an appendix. If you are listed in the United States, you have a choice. You can choose if you are going to report this as a table or as a full report. A lot of people, they prefer the table. For people that don't speak, English is not their first language, it's very convenient. But in this table, it's not really clear what is the opinion of the competent person or the CP. So there is a little bit of misunderstanding what is JORC, what is PERC, what is NI 43-101. So I want to highlight that all these codes, they don't regulate the procedure used by the QP or CP to estimate the mineral resources. The QP can decide if they're going to use computer or Excel table or just calculator or whatever, as long as the procedure is described, as long as the software is disclosed, and as long as you can face your peers and defend your statement, it's acceptable. All these codes, they don't replace the local government reporting. If you publish NI 43-101 report in Canada, it doesn't mean that you don't have to publish an assessment report for the Ministry of Natural Resources or whatever. And if you are in a jurisdiction where they don't follow the CRISCO standards and categories, you are the lucky one that have to file 2 different reports. One for the government following ABC or some kind of other categories, and one for the investment community. And all these codes, they don't regulate the internal classification and the reporting system. So what are the latest amendments? Every year, somebody decides that we have to put more regulations and we have to do something more. I noticed somebody reported exploration results and reported something like exploration target. If you have an early exploration project and you don't have enough data, there's no need to push this to resource estimate. You don't have data, you don't have data. You can declare an exploration target and exploration results. For the exploration target, you have to declare a range. For example, the exploration target has mineralized material that is from 100 tons of cobalt to 500 tons of cobalt. And the range is from 0.5% to 17%. For every other statement, you have to have one number that will disclose the tonnage, one number that will disclose the average grade, and one number that will disclose the metal content. So I'm sure that everybody knows that the mineral resources and mineral reserves must have reasonable prospect for eventual economic extraction. Mineral resource cannot be estimated if you don't have enough data. Probably every resource geologist was approached by a company that says, I have trenches and I want to get mineral resource estimate. If we don't have data, we don't have data. So these are the current mining definitions, and these are two examples. Let's see which one will pass and fail. The first one will fail because we have possible reserves. There's no such thing like possible reserve. The second one has the so-called mineral resource calculations. We talk about estimate, we talk about evaluation. Calculation means that it's something that we really know. If you have drilling every 25 meters, there is a lot that could happen between two drill holes. So unfortunately, sometimes we do make mistakes, or the company that owns the project makes mistakes, and they'll get a letter of deficiency from the regulator. And if they get the letter of deficiency, they have to reissue the report, fix the deficiency, reissue the report. And there are some unacceptable terms that people really don't like, especially the regulators. So we have, in PERC, there are 3 new categories that are not for public reporting, and they're non-recoverable mineral, non-economic mineral, and undiscovered minerals. You can't use these categories for public report for investors, but you do use them for your internal communication and when you apply for a license or when you are trying to choose a property. So this is the NIN code. I'm sure in Bulgaria you can find a lot of different historical resource estimates with the A, B, C, C1, C2. I think that this table could help you a little bit. I can give the presentation to everybody who wants to get it, and feel free to contact me. This is the conversion that is approved by the JKZ. A lot of people with a lot of experience were involved in creating this table. This is the United Nations classifications. It has 81 categories.
Tanya, if you
Nobody
could
can
just sum
do.
up now, because
Yeah.
we have to move on. Thank you.
Yeah, and this is the final table that might be useful for the people that have different categories and different resource estimates. They were prepared at different times. If you have any questions, feel free to contact me and I'll give you the presentation or the original documents. Thank you very much. I know it's a boring subject, but I hope.
Thank you. Thank you, Tanya.